One of the trickier things to understand about investing in mutual funds specifically are distributions, how they work, what they mean to you, the investor. So today we're going to tackle that slightly more technical topic. Mutual fund distributions are payments to you, the investor, for any income that the fund has generated throughout the year. They can be interest, they can be dividends, they can be capital gains. Sometimes they're paid out quarterly, often they're paid out annually. Your unit price is going to drop by the amount of the distribution because the distribution, again, is a payment to you for money that's been reinvested in the fund throughout the year, for example, okay? So your unit price drops by the amount of the distribution. If it was $10, then on the day of the distribution, it's going to drop by, if the distribution was 10 cents, it'll drop by exactly 10 cents. The new unit price will be $9.90, provided there's been no market movement that day. The number of units you own is going to increase because when you're paid the distribution, it's used to buy you additional units of your fund at the new lower price. The adjusted cost base is really important to understand, so let's kind of define it first. The adjusted cost base, or ACB, is essentially the average unit price that you've paid over the lifetime that you've owned that investment. So over time, you might buy at $8 a unit when you start. Say the market goes up, your next purchase is at $8.50. The market goes up more, your next purchase is at $9. The market goes down, your next purchase is at $8.75. Essentially, depending on how much you're buying, you're getting an average price there, and that is your adjusted cost base. Now, when you're paid a distribution, your adjusted cost base will decrease a little bit as well, because the income you're receiving is being used to buy you additional units at a lower price. Therefore, it's going to reduce your ACB. Distributions are taxable in non-registered or taxable accounts. They are not taxable in RSPs, TFSAs, or RIFs, so basically any registered accounts. You receive a T3, or in some cases a T5 tax slip, which is going to tell you the combination of potentially interest, dividends, capital gains, or return of capital that your distribution has paid you. So the interesting thing about distributions is it actually doesn't affect the dollar value of your investment. So if your account was worth $1,000 yesterday, and then the distribution was paid at the end of the day, today it's still going to be worth $1,000. The difference is you're probably going to have a few more units because your distribution was used to buy you additional units of the fund at that lower price. So mutual funds often act like a person. So here's what I mean. As a person, you might have a savings account, and throughout the year, you might earn some interest in that savings account. The thing is, you don't actually have to pay tax on that interest until you get your tax slip and then you file your tax return, right? Mutual funds work the same way. So the things that they buy, the securities they own, generate income throughout the year, but there's no tax on it. At the end of the year, they distribute that back to you and me, the unit holder, and then we have to pay tax on it when we file our tax returns.